Hello, everyone, and welcome to another Wall Street for Main Street podcast. Today, we have a special guest, first-time appearance. His name is Steve Todoruk from Sprott Global Resource Investments Limited. This guy has actually been a geologist for 37 years, and he is one of the few stockbrokers that is also a geologist in North America. He's been a stockbroker for 11 plus years and focusing solely on the junior mining sector. So, Steve, welcome to our show.
Thanks for having me, John.
All right, Steve. So let's open up with, why don't you tell our audience a little bit about yourself?
Well, I was born and raised in Western Canada, British Columbia. Went to University of British Columbia when I was 18 years old to become a geologist, and after studying for 5 years, I started working in the field for big and small mining companies. Along the way, I worked for a couple of years in an underground copper mine, learning that aspect of the business. And probably later, I guess in my mid-30s, I became the president of two junior mining exploration companies that I ran, acquiring mining properties in various parts of the world and raising money, meeting with shareholders and whatnot. And then one day, I guess about 11 years ago now, Rick Rule asked me if I'd consider leaving that job and moving down to work for him with his brokerage firm in California as a stockbroker, with my job being to pick, junior mining stocks for investors to invest in.
Okay. And one other thing is, what was it like going from geologist to stockbroker? What was the, I would say, biggest transition you had to make from just being a geologist to financial broker?
I guess to clarify that a little, I went from being the president of a junior mining company / geologist to becoming a stockbroker. Running, I guess I like to say that when you're the president running a publicly traded company, you're always dealing with shareholders and stockbrokers and fund managers, mining companies, going to conferences. So at that point, I'd be interacting with the shareholders in my company. I sort of say that moving to become a stockbroker was a sideways career change for me, still staying focused in the mining sector. But now that I'm a stockbroker, I have clients that are shareholders in public companies. So it's still somewhat similar. I'm still talking or interacting with, investors / shareholders, quite similar. In my new role as a stockbroker, I like to say that, I have the ability to cherry pick if you want. For my clients to invest their money, I'm always looking for the really good stories out there to invest in. So, call it cherry picking, which is quite fun when my job is to follow the absolute best stories out there. Makes for a pretty fun job.
Oh, okay, great. And you recently did a 20-minute video, an educational piece about junior mining and I was wondering if you'd be willing to explain to my audience just the type of life cycle that a junior explorer or junior miner would go through.
Sure. Based on that 37 years of being involved in the junior mining sector in various capacities, I've invested in these junior mining stocks, for most of my career, not just since I became a stockbroker 11 years ago. And one thing is tried and proven. I think most investors in this sector will agree that there's a very common saying out there that's very applicable. The most exciting thing in the mining industry is if a little exploration company makes a brand new good-looking discovery, and they can then go on to successfully drill it over the next couple of years and grow it into a big deposit that's good grade, and then be taken over by a major mining company. If you're an investor and you get involved in that company right at the announcement of the discovery early on, and then you sit back and ride it out, and if that junior company can successfully go all that distance and they're taken over by a major at a lot higher share price, that's how you hit the home run in this sector. You make the most money. So, I've just carried through that. I learned that a long time ago before I came a stockbroker. Since I came down here, I've just carried on with that line of thinking, investing, recommending stocks to my clients. So I decided recently to put together a talk/video on that called Discovery Plays. It's on YouTube. It's on our website under my bio at www.sprottglobal.com.
Okay, great. And I'll definitely have a link to the YouTube video below so you can look at this. And I was wondering, I would like to ask you also some questions about the junior miner sector today. Right now, the junior mining sector has been really beaten up, and basically, I would say some of them are down 70 or 80%. About this current environment, if someone had to ask you what you think about this current environment, is it a good environment to start investing, a stock picker environment, or still, wait for a capitulation type environment? How would you describe it?
Well, I guess one comment there would be, again, going back to how long I've been in this game for 37 years. I've seen lots of down cycles and lots of, bull markets type of thing. I've probably been through 6 or 7 of them over my career, and it's pretty well always the same. We're definitely nowhere near a bull market, so we're in a bad market right now, which usually means at some point in the future we're going to come out of that and move into a stronger, better market. I personally think we're somewhere near a bottom, and I kind of define that by you look at the current gold price and the gold mining companies, the big majors. Most of them are barely making a profit right now. It's been a horrific couple of years. They're cutting costs wherever they can. They're trying to fine-tune their operations. If gold was to go much lower, unless the cost of producing drop dramatically, we'll start to see a number of mines shutting down. And if that happens, if enough mines start to shut down, you should at some point start to see supply and demand fundamentals kicking in, where people want ongoing gold production. The metal price has to rise to allow for mining companies to make a good profit. So that's kind of the backdrop to my line of thinking that tells me I think we're somewhere near a bottom. I couldn't tell you if gold prices are going to start going up in 6 to 12 or 18 months, but if they just stay here and we trade sideways and we start to just slowly move up, I'll be happy, and I think it's a good environment to be starting to, for investors that don't have any exposure to this sector, to start coming in, cherry picking, buying the really good juniors. When it's this ugly out there and we've been through the tough times, you start to weed out the chaff. The surviving companies are the ones that are good and strong. They've got good projects. And in my books, those are the juniors that have gone out in the last 2 to 5 years probably and made brand new, good-looking discoveries. They've been able to drill, or they're still drilling, growing them bigger and bigger. They're good grade. They've done enough drilling that, we're starting to get lots of data, and we can start to, calculate numbers as to, how big is their deposit, what's the average grade, do they have some high-grade zones. We've had time to look into, what's the infrastructure like, is there any opposition and whatnot. So it's really easy in this kind of market to identify, I'd say, the top 5 or 10 juniors. And if you're an investor moving into this sector, you want to have a basket of stocks. You never want only one, but you want to have a very short list of the really good juniors, and have good exposure to those top companies. And they're easy to identify. It's not difficult at all. But you got to know what you're looking for. For a guy like me with my experience, I can say it's easy. You might think it's brutally difficult. So that's the good thing about being in a bad market. And if you're somewhere near bottom, this is when you want to start, cherry picking.
Oh, okay. And one other thing is, you were talking about, picking out good companies. Is there any specific characteristics that you look for personally when looking at a junior that you'd like to share at all?
Absolutely. Again, that's really simple. Grade is king in the mining industry, and that's that's being highlighted right now. What I was just saying, how difficult it is for the mining companies. In an ideal world, big mining companies would only like to mine high-grade deposits, but the reality is there's very few high-grade mines in the world. If you get one, it's extra special. They're very rare. So when I'm looking for brand new discoveries, I want to see good grade to really good grade. The higher the grade, the better, because that shows you the strength of their mineral system, the mineralizing system. And if they can grow it into a big one, that's the premium quality company. That's what the majors are looking for.
Okay, so basically, you would say grade is that. You definitely said grade was king. You've been around this market for 37 years. I was wondering, when was the last time that good juniors were this cheap?
I'd say 1999 and 2000. When I was running my junior companies, it was back in the dotcom. That was uglier than it is right now.
Oh wow, that's pretty hard to imagine. So
it's almost getting close. Just a little bit of a hint of that here the last little while. You might have been hearing some junior mining companies are starting to jump into this marijuana play. They're, because they couldn't raise any money, they had a lousy mining property. They're out of money. The new in vogue play is, seeing if they can get some of these marijuana licenses, and on the hopes that, investors that like that sector or field will give them money to raise money. And back in the dot-com, the same thing was going on. It was so brutally ugly, you couldn't get anybody's attention. Nobody cared about your story. In order to survive, companies were trying to do something .com, just totally walking away from mining. And it's not quite that bad, but I'd say right now, as bad as it is, it's not as bad as it was in 1999 and 2000.
All right, yeah, it doesn't. Gosh, I can't imagine a miner in a .com. And I was wondering
again, you got to be aware. You've got to be able to identify the good companies from the bad companies. There's a lot of companies that are, call themselves mining exploration companies. Their management doesn't have any geologists. They might be accountants. They could be just regular guys, and they don't know anything about mining, but they want to make a go of it. They want to try running a public company. Maybe they think it's easy to go out and make a discovery, so they start a company, and you get what it's got to be buyer beware. If you want to increase the chances that your little company you're investing in is actually going to make a discovery, invest in a company that knows what they're doing. They've got geologists and mining engineers strongly involved in the company.
All right. And I was wondering, you were speaking of geologists. Did you, I've read about how some people said during the 2011 top that companies also hired too many geologists to do the same things. Would you agree with that assessment?
I don't know if I'd say I've heard that. Maybe what you're saying, that when times are frothy, and in just about any business, and mining's no different, when times are frothy, when you're in a raging bull market, money's easier to raise and come by, and if a company's got lots of money, they might be willing to hire more geologists than what they need, or more engineers what they need. But every business is always guilty of that. Yeah,
that's true. So, yeah, that's just what I heard, is that they're hiring 3 people to do one job.
Yeah,
so that's
I don't know. I'm a geologist, so I've got a biased opinion. Geologists, when you're working in the field, you never have enough help.
Oh, okay. So, and one other thing is, I was thinking just, I've been reading about exploration budgets getting, from the seniors, getting completely, I guess, reduced greatly.
Mm-hmm.
Would you agree with me that that's actually good news for the juniors? Because when this market turns and they have to replace reserves, they're going to have to buy out these small companies. No?
Yes. Yeah, that's true, and I think over time that's just sort of evolved and grown what it is. Again, this isn't the first down cycle we've had. Back in 1999, when gold fell from $400 down to a low of about $250 an ounce, we went through the same thing then, that we just went through in the last year, the majors, so we're seeing their profit margin shrink. So they had to cut costs. And every time we go through this, it's the same thing. The easiest thing for the major mining companies to cut is their exploration budget. Cut their exploration budget and lay off all their geologists. What they're doing is biting the hand that feeds them. You know, the majors want to be out there discovering as well. They want to discover their own new deposits because it's a lot cheaper for them than if they have to go take over a junior to acquire their deposit. They pay a lot more. So if you're laying off all your geologists, cutting out your budget, you've just said, well, we're not looking for new deposits, i.e. we're totally reliant on having to take over juniors in the future. So that part of it's good for juniors. But there's a bit of a negative in there as well. When the majors are hurting and they're cutting those budgets, they have less money to do private placements in juniors they like, or to do joint ventures with juniors they like, or to even take over juniors that they would like to acquire. So when the majors are hurting, it's not a good thing. But we always, it goes in cycles again. When a major's hurting, eventually times get better and they replenish the cash reserves, and then they go out shopping looking to take over juniors. But it's almost a correlation. When the majors are hurting, so are the juniors. So when it's tough times, the juniors have less money to go out spending and exploring because their share prices are down low. It's harder for them to raise money. And even if they can raise money, they don't want to raise too much at a low share price because it creates too much share dilution. And that's always the number one important ingredient in any success story is the number of shares outstanding in your company. You want it always as minimal as you can.
Yeah. And I was wondering, would you agree with this assessment that a lot of people said one of the reasons junior miners don't do well or provide good returns is that they have a tendency just to issue too much equity?
Well, again, that just goes back to what I just said here. To start with, the odds of any mining company, finding a brand new deposit, making a new discovery are horrifically against them. Some numbers are like 1 in 1,000 type of thing. And so what that suggests is that for all the companies that are out there trying to find that new deposit, they only raise money by one way, and that's, doing private placements or issuing shares, usually warrants. And every time they raise some money, they're creating more dilution, and then they raise that money, they take it, they go drilling, they don't find anything. Surprise, surprise. So then they think they're hot on the trail. The last round of drilling wasn't good, but there's some encouragement. They want to raise more money to give it another go, more drilling, so they issue more shares and more warrants, creating more dilution, and the odds say they still don't find anything. Then they raise some more money. They keep doing it to the point where they get to a point where they've issued too many shares. They've got too many shares outstanding, and they don't have anything that matters for a property, and they got no money. And at a certain point, the investors just say, we don't want to finance you anymore. It's time to roll back your stock, 10 or 20 for one, start all over, change the name. So that's where my approach is. I don't like to predict which junior is going to try and make the next discovery. I don't think anybody can do that with any regularity. There's always somebody that, bought the stock before discovery, and they say, I knew they'd make the discovery. I says, oh, yeah, right, buddy. Show me that you can do that repeatedly. That's why I wait. I believe that the way to increase the chances of success of doing that, or wait till a junior announces that brand new good-looking discovery. They drill that first good drill hole that shows that it's good economic grade and it's wide enough to be mined economically. Then you increase the chances that there's a deposit present on that property. What's even better or safer or more conservative is after that first drill hole, wait for the company to drill another 5 holes or 10 holes. But the trade-off there is the longer you wait, very likely the share price has gone higher and higher. Just depends on how much risk you want to take.
Okay, yeah, that definitely sounds like feasible, and it also sounds like maybe a small dollar cost average thing might do well. Buy a little bit, and if they have a couple of good discoveries, then you can always add.
Well, the way that I'd word that is, and I have no problem, I calmly do that, is that when a company announces that first good drill hole, the discovery drill hole on a property, that's when I usually get my clients to buy the stock, call it their initial position or initial tranche. And then if they successfully move the drill over and they can keep hitting and growing the deposit bigger and bigger, whether they've moved over, they've drilled another 5 holes or 10 holes or 20 holes, the share price is likely up higher, and I'll say, hey, I'm okay, buy some more. We're averaging up. I'd always prefer to average up than average down. One means you're making money, the other one means you're losing money. And the ultimate time to do that again, to take it all the way is, the company that drills that first good hole, they announce a brand new discovery. It's going to take them probably 1.5 to 2 years of drilling to see if they can build it big enough or grow it big enough. After that 2 years of time, if they've officially done, I'm A-okay if my clients buy some more shares at that. They could be buying it the day before they're taking over, or a week before, or a month. But at that point, you've removed a ton of risk. They've successfully drilled off a deposit. We know how big it is. We know what the grade is. If you buy that stock at that point, that's what I call a takeover target, or a top takeover target. They're the junior that's likely going to be taken over at some point by a major. At that point, you're in the stock just for the takeover premium. If a big company takes them over, they're probably going to pay 30 to maybe 50% above what they've recently been trading at the previous 20 days.
Oh, okay. Yeah, and especially if it gets bought out, then, definitely sounds like averaging up is a good way of
at that point, you're just in it for the takeover premium. You're the investor at that point. You're saying, I'm not trying to hit a home run. If I can make 30% on my money, I'm real happy.
Yeah, that's true. 30% are a good return. So.
We just seen that recently here with a high-profile Canadian, call it smaller producer. They're no longer a junior, called Osisko Mining. Goldcorp came out and announced about 2 months ago a hostile takeover bid and offered, I think it was initially $2.6 billion to take them over. And then we got a bidding war happening where Yamana and Agnico Eagle jumped in there. And at the end of the day, Osisko was taken over at $8 a share. In December, they were $4. So that was all mostly because of a takeover premium in a bidding war. So that's in this kind of a market environment, that's a great profit.
And I was wondering, since you brought up the Osisko, about I just read, I haven't heard audio about it. Bidding war. I was wondering, did you think that was a good acquisition by Yamana and Anglo Eagle, or
they very likely didn't get any kind of a steal of a deal. They probably paid top dollar for it. I would say the best thing that they could hope for is if gold prices go up, and very soon. Gold goes up to $1,400 or even $1,500. It probably turns out that was a good, solid investment for them. But if we have $1,300 or lower gold price for another year or two, it's probably a questionable acquisition for them. It definitely, it definitely grows their annual production dramatically, and it's in a good, safe mining country of Canada. So those are positives, but they definitely didn't get any kind of a bargain on it.
All right. And one last thing is, in your 20-minute video presentation, you don't just talk about gold and silver mining. You actually talked about uranium mining as well. And I was wondering, in terms of the junior resource sector as a whole, whether it's oil, uranium, gold, or nickel, copper, I would say, which sector do you think looks the healthiest right now?
Well, a couple of different thoughts there from what I'm doing. When I'm looking for the next stock to recommend to my clients, i.e. the next good-looking discovery, I don't care what the commodity is. Whether it's gold, silver, copper, uranium, nickel, zinc, oil. I tend to stick more to the metals type of thing, but there's always been a mining industry. There always is going to be a mining industry, which means there's lots of big mining companies out there mining gold and silver and copper and iron ore and uranium and nickel and zinc. So all those mining companies need to be finding and acquiring new deposits. And that, for the most part, that's the role of the junior exploration company. So if a little company tomorrow announces they've just made a brand new, really good looking zinc discovery, I'm all over it. Because I know there's big mining companies like BHP and Rio Tinto and Teck Corporation that mine zinc that should be interested in that if that junior can grow that into a big zinc deposit. I'm currently in a junior that's made a brand new, really good looking uranium discovery. Uranium prices keep going down, but I'm very confident at the end of the day, a big uranium mining company will acquire this junior's deposit because it's a really good grade deposit. Having said all that, most of the junior mining sector is focused on gold exploration. Most investors or fund managers in this sector, they believe in gold. They want gold exposure, so they're going to feel most comfortable investing in gold stocks. There's very few investors or funds that are going around saying, we love zinc. We want to finance zinc or nickel or lead. So probably 70 to 80% of the junior sector is focused towards gold exploration.
Okay. Makes sense. So anytime I think of junior, I always think of gold or silver. So, so Steve, I just wanted, yeah, probably. So, I definitely would say so. With gold and silver, that's what I look for in mining. So, I was just gonna say it was actually nice having you on. So, thank you for coming on. If people wanted to find out more about you or want to inquire about your services, how can they do so?
You could give me a call at 1-800-477-7853 or email me. My address is stodoruk@sprottglobal.com. Or you can go to our website, www.sprottglobal. I've got a little bio on there. So I appreciate having you on and look forward to talking again.
All right, great. And we'd like to have you back on in the future. So thank you for coming on.
Okay, thanks, John.